Will described it at the beginning of our show today. V is for volatility. That's the name of the game. Nancy, you think we're in store for more of this. Why and how long do you think it will last?
Well, the rates market is freaking out, and I don't think the equity market has taken notice yet. We've had the biggest forward flattening in the yield curve since the financial crisis. The market has priced in a tremendous amount of hikes. Even more hikes are being pulled forward into 2022, especially with midterms. So I think there's a lot more volatility in store, and investors should buckle up and get ready for it.
Paul, do you think that this volatility stems more to the upside or the downside? I ask because Marco Kalanovic of JP Morgan wrote a note today that the sell-off narrative has to do with Fed and Omicron, but in reality, the selling is coming from hedge funds like yourself, de-risking and shorting from both the equity and macro hedge fund strategies. He says this actually sets the market up for a short squeeze and a cyclical rally into year-end. Do you agree with that?
I have a lot of respect for Marco, and I can make a strong case either way. I can make a case to be able to look at the amount of liquidity that's still in the system. And that's ultimately how I think the risk assets, equities, credit, et cetera, are viewing it, to be able to look at the amount of record buybacks, corporate buybacks. Let's not forget, we still have the Fed buying assets, even though they're tapering at a faster rate, they're still purchasing. So on one hand, you can make a strong case that risk assets will still remain supported, albeit artificially. And on the other hand, I agree with Nancy to be able to say that I think next year is all about rates. And it's really to be able to historically look at what rates did to risk assets historically. And that's always been a headwind for risk assets. But I think the risk asset market, whether it's equities or credit right now, is simply saying the party's not over. There's still an awful lot of liquidity in the system. And we're going to wait until the day of reckoning comes where we do have these hikes. And that's not anytime soon, at least for Q1 or Q2.
But Paul, will rates rise significantly at some point next year, or even when the bond buying ends?
And that's a great question, Wilf. It's if you look at, we study option markets pretty hard. And the options market in rate world is telling you that not only will we perhaps see 3 rate hikes next year, but there could be even more substantial hikes going into next year. And I struggle to believe how that is going to be a supportive environment for risk assets. So from my standpoint, it's all about probabilities. It's all about looking at the amount of wealth that your typical investor has made this year, which one could argue has been a windfall. It's been an outsized year. And I think it's time to just be able to look at ways to think about protecting that wealth that's been created this year. Because if you were to rewind 12 months ago, I don't think there'd be an awful lot of your commentators or your panelists who would have said we're going to be up, the S&P is going to be up 25, 26%. So you can make an argument that we've perhaps, in the space of, in this 12 months, we've rolled 2 or 3 years worth of returns into one calendar year's market environment based upon the extraordinary fiscal monetary programs that we're seeing globally.